What happens when a country long trapped in dependency suddenly attracts one of the Gulf's wealthiest sovereign funds? That is the shockwave from Ouagadougou, where Oman has stepped in with a bold, three-pillar package: a gold joint venture, a multi-sector investment partnership, and agricultural projects targeting rice and other strategic crops. For Burkina Faso, this is not just money. It is validation, a new model of sovereignty, self-sufficiency, and South-South cooperation. But what does Oman stand to gain? The agreements announced in the presence of senior officials were far from symbolic handshakes. They included a joint gold mining venture, multi-sector investment commitments, and agricultural initiatives focused on food security. The signatories were weighty figures. From Oman came Abdul Salam Mohammed Al-Mashidi, chairman of the Oman Investment Authority (IA), a sovereign wealth fund managing tens of billions of dollars. Representing Burkina Faso was Foreign Minister Karamoko Jean-Marie Traoré, alongside leaders from Sopami, the state mining company, and the Ministry of Agriculture. The symbolism was unmistakable. A Gulf monarchy known for its oil wealth had planted a stake in Africa not through colonial logic or donor rhetoric, but through shared ownership and partnership. The news spread quickly across the continent. In Bamako, analysts asked whether Mali could replicate the model with Gulf partners. In Niamey, Nigerians drew parallels with their own break from France over uranium. Across the Sahel, the message was clear: Burkina Faso had opened a new door, and Oman had walked through it. This was not Western aid cloaked in humanitarian slogans, nor was it an IMF loan saddled with conditions. It was hard capital direct investment in Africa's resources, industries, and food systems under terms negotiated by Africans themselves. For Burkina Faso, the timing could not be more significant. Just months earlier, the government had accelerated its resource sovereignty agenda, nationalizing parts of the gold sector and insisting that more refining be done locally. These moves unsettled Western investors, but energized ordinary Burkinab, who had long watched their gold and rich outsiders while leaving local communities in poverty. The Oman deal builds directly on that momentum. It shows that when Burkina Faso asserts its sovereignty, it doesn't scare off partners, it attracts new ones who are willing to engage on equal footing. The agreements also land at a time of profound geopolitical shifts in the Sahel. France has been pushed out of Niger, Mali, and Burkina Faso. Western influence is in retreat. In its place, new partnerships are rising. Russia aligning with Niger's nuclear sector, Turkey investing in Mali's defense industries, and now Oman anchoring itself in Burkina Faso's gold, agriculture, and development. Different deals. Same message: Africa is no longer waiting to be told what it can or cannot do. What makes the Ouagadougou signing remarkable is its scope. Most foreign partnerships in Africa have been narrowly focused, often on extraction alone. This one is broader, touching resources, food, and industry, a blueprint for a new era of cooperation. Gold, yes, but also agriculture, yes, but also infrastructure and industry. Oman did not arrive in Ouagadougou with a pickaxe and a one-way ticket for raw exports. It came with a willingness to align itself with Burkina Faso's national priorities, diversifying the economy in a way that recognizes the full scope of development, not just the most profitable corners. Western media reacted cautiously, portraying the deal as a risky gamble by Oman in an unstable region. But in the streets of Ouagadougou, the mood was entirely different. Crowds waved Burkinab flags, chanting slogans of sovereignty. For them, this was not about risk, it was about recognition. Recognition that Burkina Faso is not a charity case, but a nation with resources, vision, and the right to negotiate partnerships on its own terms. The symbolism was powerful. A country once forced to beg for aid was now signing billion-dollar agreements as an equal. The very sight of Abdul Salam Al-Mashidi, chairman of Oman's Sovereign Wealth Fund, seated beside Burkina Faso's Foreign Minister Karamoko Jean-Marie Traoré, sealing deals in gold and rice, told a story of two nations meeting eye to eye. It also signaled something larger: Africa's evolving role in the global economy. But why did these agreements begin with gold? Why does gold always anchor Africa's struggles and its victories? To understand, one must look into Burkina Faso's long and painful gold story, a tale of exploitation, resistance, and now transformation. For decades, the country's soil produced vast treasure that enriched foreign companies while leaving local people in poverty. Since the 1970s, French, Canadian, and Australian miners extracted hundreds of tons of ore. Yet little of the wealth remained in country. Royalties were meager, profits flowed abroad, and the state had almost no influence over how mines were managed. Communities living near mining sites were left with poisoned water, degraded land, and shattered livelihoods, while foreign shareholders celebrated record dividends. It was against this backdrop that Captain Ibrahim Traoré's government rose with a pledge of resource sovereignty. Between 2023 and 2024, the junta began systematically tightening control over the mining sector, creating SOPAMIB, the state-owned mining participation company, to ensure Burkina Faso not only held symbolic stakes, but decisive voices in operations. Foreign firms were told bluntly, if you want to mine here, you will partner with us. Some resisted, some left, but new partners arrived. Among them, Oman's minerals development company MDO stands out. The deal with MDO is not a concession. It is a joint venture, a phrase that makes all the difference. In practice, it means Burkina Faso is no longer a passive tax collector waiting for scraps. It is a co-owner, shareholder, decision-maker, and beneficiary. SOPAMIB now sits across the table from MDO as an equal. Decisions on safety, environmental protection, community engagement, and profit allocation will finally involve Burkina voices. The symbolism is profound. Gold, once the emblem of extraction without benefit, is being redefined as the emblem of co-ownership. And this is not theoretical. The government has already begun building its first gold refinery, with capacity to process 400 kilograms per day. Under the new framework, part of the gold extracted with Oman's participation will no longer leave the country raw. It will be refined domestically, creating jobs, building expertise, and keeping added value within Burkina Faso. The ripple effects stretch beyond economics. For communities in gold-rich regions like Hound and Essakane, stronger state presence promises more accountability. For young Burkina engineers and geologists, it means training and career paths within joint ventures instead of perpetual subcontracting to foreign experts. For the state, it means reliable revenue streams to fund infrastructure, defense, and education sectors long starved by the outflow of mining wealth. Unsurprisingly, Western investors have raised alarms. But in Ouagadougou, the story is not one of alarm, it is one of transformation. Critics call it resource nationalism. They warn of instability, of capital flight, but such critiques ring hollow and weighed against Africa's history, half a century in which investment meant little more than pipelines draining raw ore out of the continent. If that model is destabilized, it is only because it deserved to be. Oman's decision to embrace a new framework is telling. Muscat could have pursued safer returns in Europe or Asia. Instead, it chose to back a sovereign African model, accepting that co-ownership means sharing power as well as profits. For Oman, it is a bet on long-term stability and legitimacy. For Burkina Faso, it is proof that sovereignty does not repel partners, it attracts those who respect it. Yet gold, no matter how well managed, cannot feed a nation. Mines may fill treasuries, but they cannot fill stomachs. That is why the second pillar of the Oman deal is so vital: agriculture. If gold secures sovereignty, rice secures survival. And so the story shifts from glittering mines to green fields, where the struggle is not about profits, but about hunger, dignity, and food independence. Alongside the joint gold venture, Oman pledged to invest directly in Burkina Faso's farms, focusing on rice and other strategic crops. At first glance, this may seem less dramatic than gold. In reality, it strikes at the core of Africa's dependency trap: food. For decades, Burkina Faso, like much of the Sahel, has lived under the shadow of food insecurity. Despite fertile land and millions of farmers, it has remained reliant on imports of rice and other staples. Each time global grain prices spiked, whether from drought in Asia, war in Ukraine, or disrupted shipping lanes, Burkina households bore the brunt. Riots over food prices in Ouagadougou and Bobo-Dioulasso were not rare. They were reminders that sovereignty in gold meant little without sovereignty in food. The Omani Agreement targets this directly. Through its food investment arm, Muscat will channel capital and expertise into Burkina Faso's agriculture. The focus on rice is both practical and deeply political. Rice is more than a staple, it is the heartbeat of social stability. When rice is plentiful and affordable, governments endure. When rice prices rise, unrest brews. To produce rice domestically at scale is to secure not just food, but legitimacy and peace. And the deal goes further. It includes support for other strategic crops: maize, millet, and cereals resilient to climate pressures, staples of rural diets.